Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
Mary and Joe came in to see me, and on the suggestion of their sister and brother-in-law, and it was a terrible situation as Mary and Joe were almost crying when they were talking about their life savings. They lost 30, 40% of their life savings. Now at 74 years old, that was a big deal. They liked going to the casino. They liked going away and spending time with each other. But they didn't feel that they could have the freedom that they once had because they lost so much of their principal, so much of their money. They came and, as I said, were almost in tears as they were telling me about how they lost so much, 30, 40%, because the market had come down. Their financial guy had told them that their money had been conservative, but unfortunately it was a different definition. Their definition was not losing principal, and they had lost so much of their principal at this point in time. It was 2008, and Mary and Joe cried uncle. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about the topic, when to say uncle. Dad, that's one story that I've heard out of many that you've told from both the tech bubble crash and the great financial crisis. You are an educator, you've done a lot of events, and you've talked to a lot of people. Yeah, and people have those different breaking points, right? When to call uncle. Some people, you had somebody who decided to switch from the hope, the Wall Street model to the accumulation, to the dividend or the income model, right?
Right.
In our equation, TR equals I plus G, the income model. Just recently, they're actually up right now as markets have come down from that dead cap bounce we had recently, right?
Right.
But people have different breaking points. And when is it time to call uncle? Do you need to be down 20%? Do you need to be around 40%? Do you need to be down at all to make this switch from accumulation or hope to a distribution or pay me, a real investment? What do you say?
Well, your question is, do you need to be down at all? And the very basics of investing are, right, buy low, sell high. So if you're selling while it's high, you're not down. That's the best time to do it, right? And January, December, January of 2021 or January of 2022 was a great time to sell. But the point is that we're down at this point from where we were at that then. And there's people that I'm talking to. They called me last year. They said, Andrew, we've heard you on the radio. We want to talk to you. And then things happen in their life, and now they've lost money since then. And they say, well, I'm just going to wait for it to come back. And if this is like 2008, that's going to be 5 years before that happens. Or if it's like 2000 when the market dropped, that's 7 years before it comes back to where it was. But ideally, it doesn't have to drop at all. But the key is at what the today's show is when to say uncle, when to cry uncle. When are you going to do that? And are you going to wait until it drops? So many times I'm thinking of one of our clients at one point, with her house. She wanted to sell her house here on the shore in Connecticut and move down to Florida. And when she put her house on the market, she put it on here, but the market was here. And then she'd drop it, but her house would, and she'd keep dropping it, but the house was dropping faster than she was dropping it. And it's like, finally, it was like, I told her, you got to just sell this thing and get out of here because you're losing so much money on it. Get down south where houses are cheaper at the time. And, that's what she ended up doing. But ideally, you get out when you can, and with the most skin. With having the most amount of money that you can, because the compounding nature that you're talking about with the distribution model, the income model, can be phenomenal over time, but people don't get that.
And when we're talking about a hope model, we're talking about an accumulation model in life. This is when you're saving up for retirement. This is when you're trying to build your wealth. And people say, here we go again, right? Here we go again. Markets are crashing. Fed's coming out and saying, we want to bring asset prices down. So people are saying, here we go again. The difference is the people who have lived through the tech bubble, the people who have lived through the great financial crisis, time is no longer on your side. So in accumulation,
Right.
that helped you. You were saving money in your 401k. Your time horizon was 30, 40 years out, right? At
Right.
least 20 years for most people.
Right.
Well, if we're talking about the great financial crisis, we're 12 years out. You're 12 years closer to retirement. Now is not the time to say, all right, in another, 12 years, I'm sure assets will be back higher than they were, right?
Right.
So the accumulation stage of life is for when you're young, you're aggressive, you are saving money.
Yeah.
Now, in the distribution phase of life, or the income, what we like to call a real investment, something that pays you, it's more persistent, it's more dependable because these assets are paying you and it gives you optionality. You're allowed to decide, do I want to spend this money my assets are paying me? Or do I want to reinvest it at lows?
Right.
Because you have money pouring into your account, right?
Yeah.
So, for example, $1 million account rates right now, you could probably get $60,000 a year just pouring into your account. It doesn't matter if markets go up, down, or sideways. $60,000 of dividends and interest come into your account.
Yeah.
Who wouldn't like that? Now, if you want to take advantage of market opportunities, you reinvest the 60. If you want to go on vacation, you
Take
spend the
this.
60. If you need to
Right.
take an RMD, you got 60, you take your 40 or thereabouts, and you have 20 left over for whatever you decide.
Or to reinvest, right? Spend it, reinvest it, whatever. It's a great thing. It's a beautiful thing, and that's you know, but we're faced with a situation that is needs to be taken a look at. And people, the greatest mistake that people make with their money, as they retirees make with their money, is not switching, not changing from a accumulation mindset, accumulation strategy, into distribution strategy soon enough. And as a result, they run out of money. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is when to say uncle. We have a paper that we put together that we'd like to be able to give to you. And you can have that for free by calling us at 800-725-7616. This is called Hard Lessons of Stock Market History. They say that history repeats itself, right? And you're doomed if you don't know history to make the same mistakes. And we don't want you to make the same mistakes that others have made. And that's why we're trying to educate you, because people don't know what people don't know. And that's why we have Financial Strategies with Andrew and Daniel Agemy. Daniel, these things that are going on in the market, markets come down 20%, now go back up, and then it's doing all these different things. Like you said earlier, is that who was it? It was the Fed that said that they're trying to crash it. Is that right? Is that what you said? Did I hear you right?
I didn't say they're trying to crash it. I said they're trying to bring asset prices down.
Okay.
Right? When your stock portfolio is up and your housing portfolio is up, right? Your house is worth a lot of money. I mean, people are taking loans against their houses to support their lifestyles, right?
Right.
To pay for their kids' education, to buy their kid a house. This is happening a lot. Not right now, because house prices have come down the last few months. Interest rates have gone up. But this is what's happened. So actually, I did see an interesting study the other day where it showed your stock portfolio doesn't really make you feel wealthier and spend more money, because most people know that that's not something they can depend upon, right? Your
Uh,
asset went from $1 million to $2 million. People don't really count that as now I have $2 million because they know markets are volatile. But when your house does that, people feel more wealthy and they spend more money like they're more wealthy.
uh-huh.
So the Fed didn't say they want to crash markets. They said that their code is we want to bring asset prices down to stop inflation. And that's the whole thing about raising rates, right?
Right, right.
That's why the markets crashed after Jay Powell in Jackson Hole came out and basically said, we're going to stop inflation. It's very hawkish. People were expecting him to be a little more dovish. It's very hawkish. It's a lot of words. They're using their words to bring asset prices down more than their actions. And then one of the Fed officials came out after that, after the markets crashed that Friday. He had like about an 8-minute talk, right? And markets crashed, and somebody came out and said, we're delighted to see, a Fed official, we're delighted to see the result. Then he had to walk it back a little bit.
Uh,
But that's what they're trying to do, is to bring asset prices down so people spend less money. This is how they're combating inflation.
uh, so when people feel poor, they don't spend money, right? So when their house values come down, their stock values come down, all these different things, our car values come down. Um, uh, you know, they feel like they don't have as much wealth as they used to have, and so they don't spend as much money. Is right?
Exactly. Yeah.
Yeah. Yeah, I remember, my friend in 2009 was, I forget the name of the road down in Fort Lauderdale area in Florida. It's kind of like Rodeo Road Drive in Hollywood, but where, there's a lot of wealthy people down there. And he said he was down there one Saturday in 2009, and he said you could see the proverbial tumbleweeds, going around on the street because he was down having lunch, and he said there's like nobody out here, and he said, and this is like so crazy because, these are people, living down there have maybe $25 million and whatnot, right? So at this point, maybe it went down to 20 million or 15. But he said on their way up, when they went from 5 million to 10 million, they were probably feeling pretty wealthy and went and spent money, or maybe we even had 15 million, went and spent money. But now that they had 25 million, that's now down to 15 million or whatever case, they feel poor because their balance sheets have come down like that. So they're not out spending money the way that they had been
And
previously.
that's a perfect example about the difference between um, number go up, asset price go up, and having income, right? Because when you have income, you're confident. You can
Right.
spend that income because you know your assets are generating that. Or in your situation, those that money was probably a lot of paper wealth, and so to take liquidity, people would have to have a liquidity event. If they had a liquidity event, they'd take a loss
Right.
of what it was earlier, a year earlier, 2 years earlier.
Right. Right. Exactly. Exactly. And so the point is, when at what point will you consider doing something other than the stock market, right? When to say uncle? Yeah, there's been a lot of hope, a lot of optimism in regard to the stock market, and the market has come down. But people say, well, it always comes down. But like you said, Daniel, they always saying, yeah, you're in it for the long run. Well, for people 50, 60, 70 years old, the long run's behind you, not in front of you. You're listening to Financial Strategies with Andrew Daniel Agemy, and we're talking today about when to say uncle. When is it time to switch gears and to do things differently than you've always done them when you're in retirement? So we'd like to give you a book today to go along with this. It's Turning Financial Planning Right Side Up by Jeffrey Small. This is a book that's out of print. It's a very good book, but we have a few copies left, and we'd love to be able to share them with you, the next 5 callers at 800-725-7616 for free. Our no obligation, 800-725-7616, Turning Financial Planning Right Side Up by Jeffrey Small. Call now.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So, Daniel, as you know, we came out to the Denver office recently, and we had a great time out there. And when we took that, I'm not sure if when you went with us there to that Buffalo Ranch out there, it was a great time where we were able to see the buffalo, see this big ranch, see the buffaloes on the ranch, and then have some buffalo burgers at the end and that kind of thing. It was a great time out there. But it was interesting when we were riding around in the back of this trailer out where the buffalo were and driving in amongst them and that kind of thing. And the owner of the ranch was talking about how he'd been doing this for 25, 30 years, I think he said. And he said, yeah, this year has been a tough year because of all things being, equal. We haven't had a lot of rain, so they're not able, we're having to feed them a lot as opposed to just eating grass. And he said, it's not as much about what we're going to be making this year because there's not really any profit in it, is how much we have to manage the losses and keep the losses to a minimum. That's what we're trying to figure out here and how to do that. In a manner of speaking, you might say he was crying uncle from that standpoint. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about when to cry uncle and how your time horizon and your investment strategies really matter. This is not talked about enough in the financial media. The financial media are always talking about trading, what trade. But like if you have a life, okay, if you don't have a life and you want to go make trades every day, then keep doing that. But if you have a life, right, you worked to retire for a reason, you want to go travel, right? You want to go visit places and spend time with your grandkids. You're not day trading. So
Right.
You got to have a strategy that pays you. And that buffalo story, right? Out there feeding the buffalo, little Jackson, 2-year-old out there having buffalo eat the food right out of his hand. That is a pretty nice time. That was an experience that those are the kinds of things that income allows you to do, right?
Right.
Spend time with your family. The buffalo farmer is talking about minimizing losses. And if you're an investor and you have these losses, do you want to go through another period of time where you're just hoping, right? You're in that hope mentality that these investments will continue to go up, because it's crazy the valuations that we're seeing out there when the economy is stuck in the hole. Now you could say, well, we think people are just going to print. The governments are just going to print, right? They're just going to print and they're going to keep pumping up assets. But historically, we go through cycles. So we go through exuberance, and then we come back and things go back to a medium where they're able to have realistic valuations, where earnings matter in a company, where valuations matter in a company, because companies have to earn money, right? You're buying a piece of a business. I think a lot of times people get caught up in just hype of stock market and not what's actually going on, is that you're buying a piece of a company.
Right.
That needs to make money for your value in the company to go up. Or same with the houses, right? There's a statistic that just came out where the medium house is selling for 8 times earning.
Wow.
That's ridiculous. That's higher than it was in the housing bubble in 2005, 2006.
Ouch.
So
And that should,
people say, well, how is it going to come down? But this always happens when things are outrageous. Nobody knows how it's going to come down, and then it does.
right.
So either wages are going to have to come up, or pricing is going to have to come down. And that doesn't mean it will happen right away. It might be over a 5 or 10 year period of time where housing just doesn't go up and wages slowly rise over that period of time, right? There's a lot of ways it could happen.
Right.
But that's kind of how ridiculous some of these valuations are.
Yeah. Yeah. That's exactly, I get that. And, the thing that's happening, the government is doing a bad job of handling money. They're, you know, they're raising interest rates for the time being, but how long can that go for? Because they're spending money, they're borrowing money to create spending and doing the things they want to do, like you might say some good things they're doing is hiring 80,000 more IRS agents. Well, maybe that's good, because the 80,000 people are going to have jobs, right? If they can find them. But and then the FBI agents, right? But that's not adding to our economy. I mean, maybe they want the IRS agents so that they can get more taxes from people and do more audits and those kinds of things. But they're not building infrastructure. They're not building cities. They're not building things that create income. One wise lady that I know said that, there should be a school, first a government class in high school, and the first lesson should be the government has no money. The government gets money from taxes. They don't build widgets. They don't sell stuff. They take money from taxes, right? They get taxes. They have no money, and it's only what we give them that they will have. And that's what they're doing. And they're building the debt more, and they're giving people money to pay off student loans instead of helping people adopt babies and do some things, start businesses or some things that will actually help people. But we have these student loans being forgiven that people have signed up to say and promised that they were going to pay them, and it's just mind-boggling what's going on. But listen, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is when to say uncle. And a lot of things are happening out there in the market, in the world, and we want to make sure that you have what you need to live and enjoy your life for the rest of your life, financially speaking. And we want you to be able to retire and stay retired. That's why we have Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And because of that, we want to give out a paper today called Stock Market History, Hard Lessons from Stock Market History, so that you can know history and not repeat history. Well, so please call us at 800-725-7616 to get your free copy of this paper that will give you some insight that you're not going to hear typically from Wall Street firms. Yes, they know this information, but they don't want to tell you this information because it doesn't profit them. We want you to be able to be a smart and an educated retiree, because an educated retiree is a happy and stress-free retiree. 800-725-7616. Ask for it by name, Stock Market History. Daniel, some people out there might be saying, oh, Andrew and Daniel, you're so bearish, you're so bearish on the market and that kind of thing. Come on, look at what the market has done over the past, few decades, how high it's gone from that standpoint. And, you're just not going to get anywhere with your bearish attitude. And, you and I both know that that's not correct. We know the power of compounding, the power of dividend reinvestment. Want to speak to that a little bit?
Well, I don't think we're bearish at all. I may be bearish on indexes, or I may be bearish on, a lot of US companies in a basket, right? In a basket of stuff where no one's doing their own individual research. I may be bearish on a lot of housing markets, but I'm not bearish on innovation, and I'm not bearish on the US or people's ability to create new things, right? I think that over the long term, we are going to be in more deflationary world where things are getting cheaper because of technology. We can grow crops more efficiently. We can build technologies that give us more information we need to be more efficient and to give people more time off. So in the long term, I'm extremely bullish on our economy, on human innovation,
Right.
on entrepreneurship.
Right.
The difficulty is the Wall Street model is not looking at these kinds of things. Maybe like if you looked at a Cathie Wood fund, she's talking about that kind of stuff, and that's been crushed year to date, maybe like down 80% or some ridiculous number like that. So you have to be careful how you invest in those things. She will most likely be right over the long term. But like if that was your retirement money, didn't do you a lot better. I mean, you can't lose 80% in retirement, right? So the way we like to look at this, right, is what do people think assets have done? Like these enormous amounts, right? The last 10 years have been incredible. What about the last 20 years, right? S&P, I think, without any fees is about 7.5%. Actually, it's probably not even that high right now because of what it is year to date, right? That's probably a beginning of year number. People think their houses have done so well. Housing is up about 3% annualized, right?
Wow.
The average investor, people who are trading over the last 20 years, right? This is numbers from JP Morgan. They did studies, 3%. So like there's not these remarkable numbers. Now I talked to a guy the other day who switched from the growth or the hope model.
Yeah.
Over time, things go up to a pay me model, right?
Right.
And so we're talking and he says to me, Daniel, I told Andrew when I signed up that I don't want to have to sell any assets to take my requirement and distribution. And I said, well, I got good news for you. Markets are down somewhere between, and NASDAQ is somewhere between 20 and 30% down year to date. S&P is about 15 and 20% year to date. And you've generated $40,000 of income year to date.
Wow.
$40,000, right? So this is about $1 million portfolio, $40,000 year to date in income. And we always talk about that's real money that you can do whatever you want with. So you can take that for your RMD. You can give that to charities, and you could take it out of qualified plans tax-free. You can spend it. You can go on an RV trip. You can do whatever you'd like with that money. But that is $40,000 that has trickled into his account. And you know what the even more exciting part is? The estimated for annualized on the account is about 60.
Wow.
So this year has been really good for income dividend investors. Even though markets are down, there's been a lot of special dividends.
Making money.
Been a lot of stuff.
Yeah.
There's been trade outs. So even though the estimate we talk about, he's actually beat that year to date, whereas we talked about what markets have done. That's hopefully an example why people could see we're talking about this stuff. And then if you want explosive potential, you can add that to your portfolio.
Right.
Small amounts, some of these innovation things we're talking about. But you don't have to have the majority of your portfolio in that if you have a good asymmetric upside on it, where it won't hurt you at all in a bad scenario. But if it works, if this innovation happens in the future, it will make a huge difference to your portfolio. Those kinds of things is a way to balance.
Right. Cool. Sounds excellent. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy because people don't know what people don't know. And so we want to educate you because an educated retiree is a happy and stress-free retiree. Part of that education today is we like to give you this book by our friend Jeff Small, Turning Financial Planning Right Side Up. Listen, if you're not a reader, this is a short book. First of all, it's 150 pages, but even if you just read chapters 3 and 5 within this book, that's going to give you some good education, some information, be able to put yourself in a better situation for the future. Make sure that you are able to retire and stay retired. Call us now, 800-725-7616 for your free copy. We're going to take a break in a minute. The next 5 callers, 800-725-7616. Call now.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
I like free stuff. I mean, who doesn't like free stuff, right? And, marketers know that. Marketing people know that. So they're always saying free this and free that. Well, one thing I learned a long time ago is that there's no free lunches. And, so many times, right, you say, oh, free trial, right? Sign up for this thing, free trial, 30-day trial, 60-day trial, 90-day for free, but give us your credit card because, at the end, if you don't want to continue it, if you make the decision not to continue it, then you can stop it and you won't pay anything because of that free trial. That's your free will to do that. Now, what are they counting on? They're counting on you making a decision by indecision. They're counting on you to just let it go and go with the crowd and go with the flow to be able to continue so they can hit your credit card for that. So then it's not free any longer. But those people that make the decision at that point to say, no, I tried it, don't like it, want to stop it. So me, in my case, I don't try it from the start because I know what this is going to be. And my decision is I'm making a hard decision up front. I'm not even going to try it. It's not worth it to me. So I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about when to cry uncle. And we're talking about investment horizons. We're talking about decision making. And you make a decision either by purpose or by indecision, but both are making a decision. And that's, I think, what you're getting at with that great story you just told about these marketers that understand our psychology, and they know people are busy. They know people get used to a certain thing. And so they let you sign up. And sometimes I wonder if they know people are going to cancel after it hits their credit card for X amount of months, or if they think people are really going to like it that much that they continue using that. But the point is, they get a lot of people to sign up and they start charging those credit cards, and people are busy. People just let it happen. They're making a decision not to cancel it. Maybe they forgot about it, so they're not really making that decision, but it's easy, so they are making a decision. Mm-hmm. But that reminds me of maybe somebody else that wants you to stick in what they do for a long time. Maybe what we've been talking a little bit today, these mutual funds, these big marketing houses, these big brokerage companies that get you in a fund, and the longer you stay in it, the longer they make money. Now, that doesn't necessarily mean you're going to make money.
Yeah.
And then I wonder, do they really care if you make money or not? Because if they're getting paid no matter what, you might stay in it for a few months, a few years, a few decades, and they collected fees for that long. If you get out, somebody else will come in. But it's that same kind of thing. You're making a decision by indecision. Most people don't check, like, what has this fund actually done? What has my portfolio actually done? I hear markets are going up last Tuesday, but like, what have I actually done for this period of time, right? Something crazy that not a lot of people know. So we talk about Fed raising rates, and a lot of people think they're going to get to these ridiculous numbers like 5%, 6%.
Right.
But most debt between corporations and the U.S. government is 5 years or shorter. There is 40% of the S&P 1500 that cannot service their debt. That's not talking about paying off their debt. That's talking about making the interest payments. So a lot of people got the immediate needs. situated over the last couple of years because it's been really easy to refinance, right? But think about it like this. If 40% of the largest 1,500 companies in the US are not able to service their debt, and you have a whole basket of funds that owns these companies, and no one's doing the individual due diligence on those companies, what do you own?
Junk.
A lot of it, right?
Yeah. Yeah. And you own it because it's kind of like a decision by indecision. I mean, you made the decision to get the mutual fund, and made the decision to trust the manager of the mutual fund, but yeah, there's indecision because you're going to stay in that, whether it's good or whether it's bad, likely until you lose money. I mean, Daniel, remember how we've done those studies? We've looked to see how the stock market average is 7%, but what retail investors average is like 3% in the market. Well, that return is not worth the risk you're putting forth. That's ridiculous, especially when we can get 3% 9-month CDs today, or 2-year CDs today, right? So that's like absolutely ludicrous. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy, and today we're talking about when to say uncle. When is enough enough? When are you going to be able to make the change to move from the accumulation mindset into a distribution and an income mindset and compound your money the old-fashioned way through dividends and interest? Well, we'd like to give you a paper that we put together for today. It's called the Introduction Universe of Non-Stock Market Income-Generating Alternatives. Okay, so income-generating alternatives. The whole point about income is getting that. It's the chicken and the eggs. As long as you have chickens, you'll always have eggs, and as long as you have eggs, you'll eat. You'll always eat. And if you don't need the eggs, let's take the eggs, buy more chickens, and then we get more eggs. And so this report will go into that a little bit, not so much on the chicken side, but the actual logistics of how that works. It's on the income generating alternatives to the stock market. We'd love to put this in your hand today for free. Just call us 800-725-7616. 800-725-7616. Check us out on the web, agemy.com, agemy.com. Contact us from there, and we'll be able to get that to you. It's called the Income Generating Report. So we look forward to getting that to you. You're listening to Financial Strategies, Andrew and Daniel Agemy, because people don't know what people don't know when to say uncle. Daniel, when to say uncle? Like some people might say, we talked earlier about, some people might think that, they should have maybe 70% in the stock market, right? And that means 30% should be maybe a little bit, it should be taken out of the stock market. Well, people don't know what they do. And that's what this paper that we're giving to them is going to help them understand different alternatives that they have. But, the aspect of the probability, they think that, 70, they like to have 70% of their money in the market. Well, probability, what they're saying is the probability that they got 30% chance that the market is not going to do well. So they should put it in something that's actually going to pay them to earn interest, right?
Right. You should always you should make an emotional decision on your finances. Saying uncle is I give up, right?
Right.
That's what saying I give up. I give up on hope investing. I heard a podcast the other day, and it was actually a professional investor, a professional trader, I guess I should say. And he says, I went through the tech bubble. I went through the great financial crisis, and I'm sure in 30 years, markets will be up higher. But I don't have 30 years. I'm not going to deal with that, right? I got cash. I've got income producing assets, and I've got a trading account, right?
Yeah.
I'm going to do that. I'm not participating in this because I don't have 30 years.
Right.
I don't want to wait around. My money is so I can have a lifestyle and I can enjoy what I'm doing.
Right.
I already went through that. I don't need to go through it again. He cried uncle somewhere along that way and changed the strategy. Right.
Right.
We talk about saying I give up, not from investing. Don't put the money in the bank. That's ridiculous too.
Right.
From a strategy of a hope mentality that over time markets go up. Let me give my money to Wall Street. Let them collect a fee from me so they get paid no matter what. And then in 30, 40, 50 years, I'll make, 7.5% or whatever that may be, before fees. And and we're just saying, hey, there's other ways. If you are
Right.
nearing retirement, you're tasting
Yeah.
that, especially right now, because you can get fixed things that are paying 4.5%. You
Right.
can get bonds. Why do we always talk about bonds? People are like, well, inflation's crazy. Why do you want bonds? Well, first off, the US government has $30 trillion of debt. And most of it is 5 years or shorter. So they have to refinance all this debt. So every percent interest rates go up, that's costing the government $30 billion in interest. So if rates are at 3%, they go to 4%, all new debt and then all refinancing is going to have to go up. So $30 billion for every percent. Think about how large that number is. Okay. The government's just said they were going, nobody really knows how they're going to do it, but they're going to pay off these student loans. And that's about $1 trillion worth of debt is what people's estimates are. So that's going to have to get refinanced. That's going to have to come from somewhere. It's not like you can just erase it because that debt is somebody else's asset, right?
Right.
So
Right.
the budget for this year is 2022 is about $6 trillion. Tax receipts are $6 trillion. So we're funding the government by issuing debt. And we just talked about those 40% of S&P 1500 companies that can't service their debt, let alone pay. Nobody pays off debt anymore. Okay. Corporations don't pay off debts. The US government doesn't pay off debts. All they do is refinancing. It shouldn't be called the financing market. It should be the refinancing market, because when you're issuing these debts, right? So all that to say, you tell me if you think rates are going to go to 5 or 6%.
I don't.
Right, the listener, you think that's going to go up that high? You keep waiting for that to happen, because there's going to be a lot more problems in the world than we see now. If companies can't refinance, if governments can't, everything's falling apart. So rates are not going up that high, right?
Right. Right.
So when we see rates at 6 and 7% on good companies that either are paying off their debt or have plenty of cash flow to pay off their debt, but they see better things to do with their money to build plants and equipment and build income, we like those opportunities a lot, right? Because when you add bonds to your portfolio, you lower the volatility of your portfolio, you increase the certainty of cash flow, and you increase or you give yourself the ability to know when these things are going to mature. And so you can plan around uncertain things because you have cash on the sidelines, right?
Right. Right. That's beautiful, Dan. 3 things in life are certain, right? Death, taxes, and change. And you want to put yourself in a position that the change is for the positive rather than for the worse, and on purpose rather than by default. And that's some good stuff you're sharing. Listen, if you just joined us, Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And so because of that, we want to give you a book to be able to educate yourself. It's called Turning Financial Planning Right Side Up. And we'd love to send you a copy of this book. It's out of print right now, but we have some copies left, and we'd love to give one to the next 5 callers at 800-725-7616. 800-725-7616. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
AAA, you've been taking some time off, doing some working, traveling, all that kind of stuff, enjoying life, enjoying traveling, your RV, seeing the country. you came out to Colorado and you decided to venture out to some very remote property.
To say the least.
And on that very remote property, there is a nice little brook.
Right.
And the brook trickles down, and it always flows. Sometimes it's a little bit faster, sometimes it's a little bit slower, and it flows down and it fills up a lake at the bottom of the mountain. Um, when we talk about this, there's all kinds of trees and stumps and leaves and branches that are blocking the flow of the lake or of the brook. And as we moved those branches and we started cutting up the fallen trees and clearing that, the brook turned more into a stream, and it got a little faster, a little more aggressive, and a little more dependable, right?
Right.
Where you could create a wash basin or you could get water out of it to put out a fire. And it didn't change. It didn't slow down the stream.
Right.
It also starts creating this lake at the bottom that's always filled. That's a reservoir, right?
Yep. Right.
And this is something that people can do with their portfolios. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Daniel and Andrew Agemy. Today's topic is when to say uncle. And, we're looking forward to what we've been talking today about what's going on out there in the stock market, what's going on in the world, what the Fed is doing, these kinds of things, recognizing that there comes a time in people's lives when things need to change. What they do with their money needs to change. Just in the same way that when your child went to a pediatrician and they became an adult, they stopped going to a pediatrician and they went to an adult doctor. And in the same way that your finances that you've been doing your whole life, that once you hit 50, 60, 70 years old, you need to change from an accumulation, aggressive mindset into more of a distribution, reinvestment mindset to be able to put you in a good place. As we know, three things in life are certain: death, taxes, and change. And the question is change going to be for the good or for the better, or for the worse, rather? And Daniel, I love your story about the brook, because that's exactly what happens with the finances, right? And you start small, and kind of like when I talk about the chicken and the eggs, right? Maybe you start off with 5 eggs, right? And then, as things move on, you take those eggs, you buy more chickens, then you get 6 eggs, and then you buy more chickens, you get 7 eggs, and that's the same thing that's happening with your brook. But I love that pool, that reservoir of water, because that's, there, when from a financial standpoint, that's what people have to be able to, live their retirement, make sure that they have what they need to live the rest of their life. Right.
Right. And, people are used to turning on the faucet and water coming out. And when you need the dependability of that brook, right? You want that to be there. You want that to be powerful. And that's the same with your dividends. When you're young and you're accumulating wealth, you don't really need it. You got a faucet that just flips on whenever you want it. Because over time, the faucet will always work, right? Over time. But there may be weeks or there may be months that faucet doesn't work.
Right.
Especially when times get rough. And that's when you really need it the most.
Right.
Whereas with the brook, you start clearing it out and it turns from a little stream to a bigger and bigger stream. It's more dependable, right? That's like the income that's switching from that, hope over time, right? To I see this flowing right here. It's dependable. This is mine. It's coming down and it's building up that reservoir down at the bottom so that you have the income and you've got cash down there at the bottom ready to deploy for buying opportunities, ready to use to support your lifestyle, ready to help people in need, ready to donate to causes that you care about. And that's when we're talking about dividends, it's turning a little brook, a little stream into a river, right? You
Right.
could have a river of dividends and interest coming into it, filling up that reservoir as full as you want it. And that's a I think an example where people can see what we're talking about. It's not a bearish stance. It's just changing to a more defensive, dependable
Dependable.
stance.
Yeah. Right, right. And the thing that I like about your analogy there, Daniel, is the aspect that it's natural. The stream is natural, right? The brook is natural, the stream is natural, as opposed to turn the faucet, turn on. You got to have a pump to pump that up from that standpoint. So it's
Or you're
not
depending on the utility company, you're depending on the pipe, you're depending on
right.
the city, you're depending on you paying the electric bill, right? There's so many things that you're not in control of.
Right, right, exactly. And so we're just wanting to you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is when to say uncle. And with that, we're trying to help educate people so that they can make a smart decision, because an educated retiree is a happy and stress-free retiree. Daniel, we have just a few minutes left, and the show today has been going pretty fast. And before we leave the air and leave our audience, just trying to think, how can we wrap this up? We've given away the paper on universe of income generating alternatives and investments for people to be able to understand how that they can do things differently than what Wall Street wants, because Wall Street just wants their money in the market for as long as possible so they can make as much as possible and don't really care about what's happening to them. What do you have to say as we finish up?
Well, markets go up by two ways, right? One is multiple expansion. So people are willing to pay more money for a company because they think that the company will earn more money in the future.
Right.
The other is because the company is increasing its earnings. And so at the same multiple, the same amount of times per earning that you're paying, it's rising because the company's earning more.
Right.
And the last 10 years, it's been a lot of multiple expansion.
Right.
And that could only go on for so long.
Right.
We talked about decisions, and you either make a decision on purpose or because you're forced to,
By
right?
default. Right.
That might be forced to by default because you don't do anything, or that might be forced to by default because the pain is so bad now you have to do it, right? So step back. The mantra was, don't fight the Fed, don't fight the Fed, don't fight the Fed, right? The last few years. And look what the Fed's saying. If your portfolio is not generating enough income to support the lifestyle you have, do you want to make a conscious decision to try to switch this to a income model where you can depend upon your income, or do you want to roll the dice and see if you're forced to make a decision to do it later, like your story at the very beginning of the show?
Right.
We see most people don't want to be forced into it when their assets are already down 30 or 40%.
Right. And the income model, a lot of people think, well, I don't need the income. I've got a pension, I've got Social Security, I don't need the income. But the whole idea behind the income is it's a definition of investment is something that pays you. Well, the income is paying you. If you don't need it, that's fine. We reinvest it. And that's where we get compounding. Growth in the market, in growth stocks, you do not compound your money. It just goes from $10 share, $11 share, $12 share, 13, whatever. But it can also go backwards. That's not compounding. Compounding is when you have $100,000, you get 5%. That's $5,000. And if you don't need that the next year, you've got $111,000 because of the compounding, and so forth and so on, and just continue to building up, so that in that example, in about 14 years or 12 years or so, you've doubled your money. But that's what we're talking about. It's time to change. When to say uncle, and when to change from a growth mindset into a more dependable, distribution mindset, so that to prepare you for retirement, to be able to have what you need to live the rest of your life. Well, and in closing today, we'd like to be able to give you this book. This is Turning Financial Planning Right Side Up by our friend Jeff Small. Easy read book, about 150 pages. If you're not a real big reader, just read chapters 3 and 5. But we'd love to put this in your hand. It's out of print, but we have a few copies. We'd love to give to you. The next 5 callers, 800-725-7616. 800-725-7616. This is Andrew Daniel Agemy, financial strategies, because people don't know what people don't know. Glad to be able to have you with us today. We'll look forward to talking with you next time. Until then, remember, if you want your retirement to be stress-free, invest for the I, not the G.